organizers as well as today we have a great panel here with good experts on the liquidity side from liquidity providers to trading platforms. And liquidity has been a big topic over the past year. Many events have happened on a industry level and macro level that is affecting it. So today we're going to be talking a little bit about that, challenges, what we can do, and and with that, let's get it started. I want to start with a quick round of introductions. Tell us a little bit more about each one of you. What do you do and what's your role in the liquidity side?
Good morning, everyone. Nice and bright early. Thank you for joining us. I'm Audris Siow. I run business development efforts here in EMEA for a firm called Talos. We are a global financial services technology firm that helps bridge or the connective tissue that links institutions with digital assets through infrastructure solutions.
Good morning, everyone. Duncan Trenholme, Managing Director and Global Co-Head of Digital Assets at TPICAP. TPICAP, we're the world's largest interdealer broker and venue operator, meaning we run markets in traditional finance and now crypto and digital assets, which is what I oversee.
Yeah, morning, everyone. James Stickland, CEO of Elwood. Elwood is a portfolio management, risk management, and execution management infrastructure company for digital assets. So connecting and helping our institutional clients manage their entire sort of digital portfolios.
Good morning, I'm Kevin de Patoul. I'm the CEO and co-founder of Keyrock. So Keyrock is a digital asset market maker. So we make markets on more than 85 exchanges, both centralized, decentralized, and provide access to our deep liquidity as well through our OTC desk. So we're founded in Belgium, active worldwide. Just started activity in London, I think 2 or 3 years ago, in Switzerland recently, where we got regulatory approval as well for OTC desk. And yeah, very happy to be speaking here today.
Awesome. So in simple, direct terms, liquidity refers to the ease in which an asset can be sold into quick, ready cash, right, without affecting its market price. Now, for a bit of context, last week on Coinbase, if you wanted to either buy or sell 20 million worth of Bitcoin, the price would have dropped either immediately 5% or jumped 12%. Not that institutions would go and smash the screens like that, but that gives you an idea of like how can like one of the largest exchanges, regular exchanges, have such thin books right now. With that, you all play an essential role in liquidity. What have you or your teams come across with like any challenges or anything that you can share with us on that side? Sure.
I think along with challenges always presents equal opportunity. I like to think that way. Besides obviously trying to make sense a bit more for our client base, the offering on, trying to get liquidity in an aggregated form that's valuable to them. There's been also a lot of new emphasis on how risk management is being viewed for digital assets. And I don't mean it from a counterparty risk, like a lot of us have spent lots of time in the recent months, particularly past year, around counterparty risk, but also risk management from the point of view of market risk. So we're seeing a lot of clients now actually having the conversations with us around how they can look at from an investment point of view to tackle, the question of liquidity. So around optimization of their investment portfolio, how they will involve the valuation of digital assets from a risk perspective. So that sort of risk management, I think it's a growing opportunity for the industry and for partners alike. I think the second one around sort of challenge and opportunity, obviously, let's not do the big R word, regulation. So while all waiting through that, and through time, I think we'll get more clarity. But through regulation, I think itself, it presents quite a lot of opportunity. I think one of its the main one is always demand for transparency. So again, we're seeing a lot of challenges around that, in terms of transparency, but also the opportunity set there is great in terms of the data that we can all amass. We've got great capabilities around technology advancements. So analytics is another key one. So I would say risk management and analytics have been really sort of key focus a lot in the last 12 months from us.
I think when we're talking about institutions coming into this asset class, one of the things that you've highlighted there is the ability to do size in a market. And until you have that type of liquidity, it's very difficult for an institution to come in. I think first they have to find the right venues and places to trade or to hold their assets. And before they even get to the point of seeing what the liquidity is like, one of the problems we have across the market currently is, does a venue or a service provider or a custodian have the right regulation? Is it in a major financial jurisdiction? Can you get comfortable with that service provider as a institution? And then if you can find the right place to come and access the market, TPICAP, we're a business to business type business. So we only face wholesale customers. We don't deal with retail customers. And I think that for crypto to move into this next phase where you do have, and when we say institutions, we mean real money, asset managers, hedge funds, banks coming into the space. You need to, I think there's going to have to be a coalescing of liquidity around maybe less venues, but where those venues are in operation, they have the right size that an institution can come and trade through it.
Yeah, look, I'd echo Duncan's view. I think, Ray Dalio said 6-9 months ago that the reason why they haven't been able to do anything of any substance is because the depth and the liquidity pools aren't there to be able to trade in any order of magnitude. I think, again, we're predominantly focused on institutional clients. So there is a challenge when there aren't big pools of liquidity to be able to trade, any order of volume. I think, again, if you went back 2 years or, maybe even less than that, 18 months ago, the ARB type trades that people were able to generate on really large spreads, those have clearly come in. So now people need volume to be able to generate the same degree of return. So I think that while the spreads were so wide, the liquidity pools and depths weren't quite as required or quite as focused because people could make, good margin. And there was obviously all the FX traders that were jumping in to start trade digital assets. I think now those margins have certainly come under pressure. And now people are clearly not the same degree of order of magnitude of spreads that they're looking at in FX, but they are still a lot sharper than they were before, and thus everybody's now looking for real volume, real large trades, real large opportunities, and again echo the thoughts of Audris and Duncan as well. Like with that, if you're going to put large volume to work, you need to feel comfortable with the infrastructure you're working within. So how do you feel comfortable with the same frameworks that you're used to, be it prime services, be it, is the frameworks, all the sort of boring stuff that we don't necessarily want to wave flags about and say are super interesting. I think all those elements are needed and necessities for large volume to come in from asset managers, hedge funds, and tier one banks.
Maybe I'll just start by saying if you guys have clients that want to trade at size, I know place where they can, so really don't hesitate to send them our way. Our booth is right up there. But when I look at what happened over the last year and a half, I think the main difference is the kind of time horizon that you're considering. I think that it was very bad on the short term. If as a firm you want to optimize and maximize your profit for 23, it was a terrible year. So was 22. I personally don't care about 22 and 23. If I look on a 10 years horizon, I think that what happened is amazing, because it helped filter out a lot of actors that had no place being there in the first place. And so, of course, this, for us as a market makers, as an OTC desk, we're competing for flow. And so all of a sudden, yes, the liquidity was more challenging, the spreads were wider, less volume, but there was a lot less people to compete with, because anybody can make a price and be happy to just have long exposure when the market is up only, and when you can offload whatever risk you take to anybody, including your grandpa. But when the market is as challenging as it is now and has been for the last year, the people that actually remain, they mean business. So that means, of course, we know that the people we're competing with now that are still there are very good. But it also means for us that our clients, both current and future clients, know that we've pulled through it, which means we're very good as well. And so I think that's on the long term, that's clear an opportunity. And that is an opportunity for all quality players that are still very active and growing in the space today. So I'd say short term is challenging for sure, but I think you should not optimize for the short term when you work in digital assets. And so when you look at that, I think it's been definitely a good opportunity.
Yeah, it's funny. You actually mentioned something that reminds me, I find it quite intriguing how in different parts of like the cycles, there's suddenly like 1,000 market makers, and then a month later there's only like 20, right? And like a few months later there's like 1,000 again. But a couple follow-up questions on that. Kevin, for instance, there's the ratio of CeFi exchanges to DeFi exchanges. There's very few CeFi, a lot of DeFi, right? How was like from like yours, how do you actually spread liquidity across so many venues? Because that's another problem that we have in crypto, right? Like spreading this liquidity across so many platforms.
I mean, it's definitely a challenge. Like, so Keyrock, over the years, we've integrated, I think we're getting almost to 90 exchanges, centralized, decentralized. And so it's definitely something that, it's, the integration itself is okay, but then it's maintaining, and it's kind of exponential complexity as the overall platform grows. So it is definitely one of our main technical and operational challenge as a firm. But I do think that this is part of our role, right? And so the way we started the company is to be really providing market making services to exchanges and to issuers. So we did not start as purely a prop shop that wants to optimize its return on one exchange and just going to focus on making that connectivity the best possible. We've built our entire tech to be able to handle a very wide spectrum of venues to trade on, because they all fail differently. They all have different level of quality, different errors, different things that you need to handle. And basically, we've built our entire system for that, because we see that this is where the opportunity really lies for a player like us, especially. So you mentioned there's still even more decentralized venues, because the barriers to entry are even lower. So I think we're in an industry where innovation goes incredibly fast, because the barriers to entry are very low. So this fragmentation, I believe, is going to remain much higher than what you would see on the traditional markets. And so we do see that as a competitive advantage for us to be able to handle something very wide and to do it at a good level of quality. But clearly it is one of the main challenges.
And add to Kevin's point about that, around the fragmentation, but also multiple angles for connectivity, and also your point around the collateral, sort of the coming together of fragmented liquidity between CeFi and DeFi. But one of the things that we are constantly being asked, and that's what we're actually working towards, is actually almost like having a common layer. So we talk about standards, and we'll be talking about standards a lot across today, I think. It's around the sort of the common language around the technical protocols and the interaction, and where Talos fits in. I think we often provide that layer where it doesn't matter what sort of counterparties you are going to be interacting with, be it exchanges, regulated venues, OTC desks, or market makers. So long there is that common element of how you interact with liquidity, it provides that standardization. I think it gives that level of comfort, which also helps organize us in general, right, as an industry. It's probably going to be that extension into DeFi liquidity. It's coming soon, but as Kevin mentioned, I think the barriers of entries are very low, and I think that's also the perception that people go away with, thinking because it's low barriers to entry, it's easy, but it's a highly competitive market as it is. So what needs to have lots of considerations around the technical infrastructure that's being built, and it's rapidly changing as we speak. So the idea is to actually, while the pace is there, sometimes I think it's important to also sort of observe and reflect first before you take the next move. So longevity is a big yes for us as well, in terms of sustainability, in terms of the business models that the pools are offering to our clients. Yeah. So
touching a bit back, infrastructure, Duncan, James, you both mentioned institutions feeling comfortable with the infrastructure, like a trading platform they're using. Can you touch a little more on that? Trust has been lost a little bit, right, over the past 12 months. It's coming back now, but what are institutions looking for? Like, what would make them fully trust a platform, or them feeling comfortable with it? What are they looking for, I guess?
Good question. I think, and it varies depending on the motivation to enter the asset class and the investment case for coming in, because that can, if it's a risk return type scenario, if you want to be in the asset class, you want to be in there quickly, and you feel like there's a lot of revenue to be generated, then potentially you can take more risk. The climate we're in currently, given what happened in the last few years, and there's no common investment thesis at the moment for entering crypto, firms are going to have to be very sure that where they're entering the asset class is very safe. But it's very common things, right? It's is the jurisdiction of the service provider, a major financial jurisdiction, New York, Singapore, London, these major financial centers. And that's important because if things go wrong, you know that there's clear regulation and clear legal systems for recourse, and you're taking more risk if you do it in a jurisdiction where you don't know how that process is going to unfold if things go wrong. And that's not a ephemeral risk. That's a risk that people actually wore in the last couple of years. And then it's a question of getting under the hood of the service provider, like has it been audited? What technical solution they have? How many assets under management they have? What is the volume there? These type of things are the things that a firm will go through. And usually the onboarding process can take, we're not talking days or weeks, we're talking months. We see questionnaires that come from financial services firm with like 600, 700 questions on it about your security, like how do you do your network security, all of this sort of stuff. That just takes time.
No, look, it's wildly boring, but it's wildly needed, right? So the DDQs of 20-page DDQs with the requirements of visibility into your audited accounts. I think like it's essential in the financial framework, both for technology and for counterparty risk management. So, I think digital assets, and I was just saying outside, the amount of clients that have said to us, we don't do crypto, but we absolutely do digital. And we're happy to use the same framework and the same technology and the same engagement process, but please don't talk about crypto. We only do digital. Is somewhat mind blowing, but I think that they want to use the same frameworks. We want them to be privy and party to this, because I think the pie gets bigger if we're all under a kind of sensible management framework and a sensible kind of structure. So we've even spent time going to visit some of the CeFi exchanges, like that's how old I am. Like when you actually go visit vendors and partners and kind of understand, do they exist, or is it a PO box with a bunch of people on beaches in Bali or wherever it may be? And that's not a bad thing, that they're on a beach in Bali, etc. But like, I think there's a necessity for some more transparency on, the structures, the books, the capabilities, the processes, etc. Because, nobody wants the similar issues that we've had over the last, 2 years, which, only set us back. Yeah, I think it washes out some of the, bad actors and challenges and the weaker kind of Darwinist, kind of theory, but we don't want to slow this thing down anymore. I'm sure many of us are in it for the next 10, 20 years of a, revolution of the, financial services ecosystem, but, we could do without more bumps in the road. So I think that boring judicious structure is not a bad thing.
Maybe just I have one thing on that, actually. What I find interesting is that it seems that when it comes to trust and the maturity of the market we're operating on, digital assets is now just catching up with the traditional market. And that's quite interesting because the whole thing started with an ethos of we're going to build a better financial system. And then for a few years, we actually went in the worst possible scenario, which is we're going to do both centralized and no transparency. And it's going to be everything based on trust and we'll be fine. And of course, it led to, of course, it's always easy in hindsight, right? But it led to what happened last year in 22. Now we still have a lot of centralized, but we're adding more transparency, more, regulations, more controls, more framework. That's great. But I'm very keen to see what comes next as well. Like, when do we not only catch up with the traditional system, but actually make it better and start to actually instill some, some part of the decentralization that, gets us all excited, but that we know it's very hard to actually touch at an institutional level right now. But how do we start to put some of that decentralization ethos in what we're building to make sure we not only get something that is as good as what we had before, but that we actually build something that is better, and including in terms of trust, is that you need to trust and verify, but hopefully if you have enough decentralized tech in there, you don't need the trust anymore, and you don't need the verification anymore, because you have something that can potentially just work if you use it at the right stages of the value chain. And that's honestly what I hope development of the next cycle will be about, as you see more and more of the decentralized finance maturing as well. Like, you don't need to be 100% centralized or 100% decentralized, but having something that takes the best of both worlds to create something better, I think is quite exciting.
Well, one of the trends we're observing at the moment, and this was pointed out to me by our liquidity team, which came across from the FX market. When you have a fragmented market, which crypto has been previously, and whether that's a geographical fragmentation or a sort of infrastructure fragmentation. And what I mean by that is, if you hold funds at a centralized exchange and then you see a price on another centralized exchange you want to trade, you need to be able to get capital there to actually execute on that. So what you've seen, a function of that, is a lot of liquidity providers who construct their price. They're based off prices they're seeing elsewhere. And like typically in FX, that's referred to as the recycling of flow in general. And it tends to be, I guess, what FX people refer to as like slightly toxic flow, because what happens when there's market dislocation and price changes dramatically, if you're constructing your price by taking the price off a lot of different other venues and then blending that to your price, if the price moves, suddenly the liquidity can disappear very quickly. So one of the things I think, and interested in Kevin's thoughts on this, you need more LPs in the market who have genuine price construction, like they're building their own price based on a variety of factors, as opposed to taking prices from other places. And that's gonna have to come to the market, because as liquidity consolidates in certain venues, you aren't going to be able to have edge if you're just recycling flow.
Yeah, I think I agree. I mean, I agree with that. You need to have, to some extent, your own conviction in the price that you're making that allows you to stay a bit longer, or you need to be the absolute fastest. It's one way or the other. But definitely, the first scenario is better for the market as a whole. That's for sure.
Wow, we touched a lot of things with this one question, so I hope everyone took a bunch of notes. This was very interesting. Moving on to quick mention on derivatives. There are, just for like some data points, right? There's about like 70 centralized exchanges that offer either perps, futures, or options. There's 426 DEXs that offer also like all combined those products, and the volumes, or if you look at the open interest for the CeFi exchange, is about like, it's in the 40 billions or more, 43, 44. And the decentralized exchanges, it goes down to like 1.5 billion TVL, right? So there's a lot here that we can cover. But I guess what are some of like the obvious, or like why this is happening, right? Institutions probably prefer CeFi over the DeFi for now. But yeah, what are your like general thoughts with knowing this data?
Well, the stats itself it shows the 80-20 rule again, a concentration of, there's plenty of offerings out there, especially in the DX space. But again, when you look closely at the data, the volume is very concentrated in the top few instruments, in the top one or two venues, both in the CeFi, even the DeFi space. But just touching upon derivatives as a whole for clients, I think the option for options is an interesting one. I think it's one of the sort of financial instruments that might hold a bit of mystique of aura for some, but I would say it's actually a very welcoming instrument class, because it helps investors get involved, still stay involved in the market when it's kind of sideways. I'm going to say, we're not alive, but volumes have not been as wonderful, as great as the past few years. But in a sideways or sort of a lateral movement in the environment like what we're seeing at the moment, options as a trading instrument itself actually gives a lot of choice to investors to come in and out. And then I think the overall growth of that is just going to keep going. It's more about also the promise of what options or derivatives can bring to the crypto or digital asset space. If you look at it, compare that with your real-world asset or your traditional finance areas, where you look at option valuations, about 20% or 30% of the contracts that are out there in traditional exchanges. At the moment, for us in the crypto space, probably about single digit, 2-3% of the open contracts out there. But people can see what the excitement and potential it can bring, tenfold multiples of the growth. So I think that's why we're seeing a bit more interest in that. Having said that, though, I think all the points that the panel has brought in terms of liquidity getting into DeFi space remains equally, present, whether you're trading a spot or even a futures. The challenges remain the same, but I think what the silver lining is, if we are going to put more discipline around the transparency, regulation, and particularly focused very much on the CeFi liquidity that institutions seem to be much more comfortable with in the first get-go, the same discipline applied to DeFi liquidity will therefore reap the same sort of benefits and consequences, I believe, around derivative trading.
I mean, I think I'd just add on the derivatives front as well. I think, while you've got large institutional, banks, markets desks that aren't really able at this point to understand the risk-weighted assets they need to hold on balance sheet to hold spot, derivatives opens up a huge opportunity for them to enter the market in a very active way, to trade the asset class of digital. So I think, derivatives, futures options, that whole kind of ecosystem is a great way of allowing people to have, cash settled, execution opportunities, non-spot based kind of action, for them to start testing this process out, testing systems out, testing their risk profiles out, testing their, infrastructure capabilities out, and actually having some exposure, while they're still waiting to understand how it lands with the regulatory landscape in terms of how much, risk-weighted, assets and capital they need to hold and weight that balance sheet. So I think, we, are big proponents of obviously the derivatives ecosystem. Again, it lends itself to a, regulated environment, securities, et cetera. So, ensuring that people have got a regulated framework, I think is also helpful there. Because again, we just want to reduce the barriers of people to be able to trade this and increase the liquidity pool. So yeah, I mean, we're seeing a lot more large tier one institutions, be it asset managers or tier one market desks, say when we start, or we've already started, it's in a derivatives, kind of ecosystem as opposed to a, trading spot.
That area really hasn't noticed the bear market either. Like if you look at liquidity so we're the largest block facilitator on the CME products, and that's just continued to grow in size.
Right.
Really since the FTX impact into the market. It's just pushed people onto regulated venues in general. And one of the surprising things in that area is a lot of the trading teams aren't crypto evangelists. They just have trading strategies that they deploy across other asset classes, and they're like, oh, here's another asset class that also has options that we can apply the same option strategy we have on oil or on other commodities just to this. And you're like, wow, this big institution has come in and started trading crypto, and you're like, so talk to me about. And they're like, no, it's just another asset class. You're like, oh, okay, well, that's good.
Yeah, well, again, it's a commodity, right? So a lot of the options traders that were trading commodities, they just see it as like, oh, great, now I have something else to add to my book, right?
Yeah.
Yeah. On that note, actually, so options in 2021, it was about 0.4% of the global volume, including all instruments in crypto. Today, it's 3%, right? And even through this past year, liquidity with options has been pretty good. So what do we think that it's happening here? And how are you looking into the future with, options?
I mean, typically options are used to manage risk. So for a lot of producers, consumers that have natural, they create a commodity or they use a commodity in their own service in general. They want to manage their exposure and risk, and then you have a lot of sort of liquidity providers and trading firms in between who can speculate on the market, and you can trade the volatility, and even in a sideways market, you can make money by pricing certain strategies so that as long as it stays within a trend that you're taking some P&L. So there's a whole variety of reasons why an institution will come to the options market. What I would say is I don't really feel like we've seen many natural producers or consumers. Like, think about it this way: the firms come to crypto to trade the price, the volatility, and speculate on it. You don't have yet many wholesale institutions that say have treasuries in crypto because they issue NFTs to their customers, and therefore they want to manage their risk on their crypto treasuries moving forward. Like, we haven't got to that stage yet, but you're starting to see a few signs of firms like that.
Yeah, I mean, I was saying I think they're just better instruments for institutions in terms of capital efficiency and how tailor-made you can make it to your risk and the exposure you want to get. But so definitely that is, as we see more institutions moving in, it makes sense, that this is the types of instrument that would grow the fastest, and I think it's going to continue to be the case because so you mentioned that split right between options and spot on crypto. If you look at what it is on equity, for example, I mean very clearly you see where there is some catching up to do. So I do think that options is a very big lever for growth, and maybe to touch upon the fact that there's so many DEXs and so they have so little volume. I think it's linked to the fact that those instruments are more suited to institutions, and when would an institution actually start trading on the DEX, and why are they not? And so Keyrock, we started 6 years ago. We have a team as Keyrock Labs, actually dedicated to interact with DEXs, different protocols, provide liquidity algorithmically in those pools, and so they do a lot of things. And despite that, we have very strict limits as to how much capital we're actually willing to deploy on those protocols. And why is that? It's not because they don't cover enough instruments or they don't have enough leverage, or it feels like many of these new projects are focusing on the bells and whistles a bit rather than the core thing, which is how can I make sure my capital is not just going to evaporate 1 minute to the next, or at least not because I made a bad trade, it's just gone. Right. And that's the main reason. And I mean, even for us, institutions, but very much crypto native, as much as we are keen to develop, what happened on decentralized finance, keen to make those DEXs grow because they do bring a lot to the actual market. As I said before, that's where the opportunity is to make something better. There is still just too much risk that can hardly be controlled in terms of just smart contract risk. I mean, even the longest standing one, they still get drained eventually. So that's definitely something where institutions are going to be less keen to allocate a lot of capital at once. So that means they need to attract many customers that we deploy a little bit. And that takes time, which is why I think you have kind of that mismatch currently. But yeah.
Right. Yeah. And another data point, it is, I think the TVL for options on DeFi platforms is only 40 million, right? So, and that also comes to for market makers, it gets expensive to spread liquidity across so many contracts when they're fully collateralized in DeFi, right? So earlier you were mentioning a bit of a CDFI world, so maybe there's something here that can be done too.
But I think DYDX is a very good example there. I mean, they are, to some extent, they're a bit in between, right? Bringing some elements of DeFi that are great, keeping some of CeFi, that reassure everyone, and you see the volume that they're trading. I think it's a very good example to look at. Mm-hmm.
So, move on to a new topic. I guess a hot topic on crypto Twitter is valuation around some of the tokens, and how should liquidity in that specific token be part of how we value these tokens or part of the market cap of it. What are your thoughts? And this is more a general opinion, but what are your thoughts on this, or how can we give proper valuation to these tokens, taking into account the liquidity in that specific market?
Yes, so, you're responsible for pricing it.
But I think liquidity, of course, is always a function of price, right? Because if you can get in and out of an asset faster, it's going to be, you're going to be more or less willing to actually hold it, and you're going to value it differently. I think that what we need to make sure is that there are, launching events that still make sense. And we've seen some example recently that just don't make sense at all, where you have a few institutional players that have a ridiculous amount of the free float, at listing, that have options deal with Strike that are simply discussed behind closed door, and then they make it happen. And guess what? The market doesn't move. Well, of course, because there's 5 retails and 2 institutions that have 100x more capital to play with. And I think those deals don't make sense at all. So liquidity should be included in any pricing model, but I think we should still keep a view of what is a good deal for the market as a whole, and not something that is simply fully controlled by 2 or 3 players.
Any round thoughts?
Well, I think within traditional finance, over the last 10, 15 years, it's become very common to look at liquidity risk around, if in a distress situation, if you had to liquidate said asset, what's your slippage going to be? And therefore, how should you value that on your balance sheet? I think that's a very sensible approach. I think we saw with FTX that liquidating FTT was not an easy thing to do. I think it will come to crypto. It's going to need to. I'm sure it's something that's permeating through crypto at the moment. I think that's easier to do with more mature assets. One of the things that is really intriguing and about crypto is this idea that it's almost like you have seed firms that are immediately liquid and sort of publicly tradable. Like the idea of if you gave seed investment to your mate's startup and his or her kind of equity was immediately tradable, how do you manage liquidity risk in that? How do you look at, if you had to sell that asset, what it would be worth? So there's just a lot of assets in crypto. A lot of them are very early type projects. So looking at liquidity risk in that is incredibly difficult, but we should be able to do it for the more mature assets.
Mm-hmm. How would you measure then liquidity risk? Are there any specific metrics that, or maybe some you don't want to share?
Well, there's teams of specialists at banks that do that. It's not my area of specialty, to be honest.
All right. So currently, we have a lot of borrowers, but very few lenders, right? And for obvious reasons, very related to liquidity. But as we enter a new cycle, the way that credit markets in crypto worked last cycle will be completely different to how we see it right now. There's going to be a lot more thought in the process, but how do you envision this new, I guess, like credit 2.0 version in crypto that we're going to see during the next cycle?
Better risk management, hopefully.
Yeah, risk management. Lack of safeguards at the moment. So now we're hoping there'll be more safeguards, right?
I'm sure that the desk you're on board with actually survive, for a long time. And so, but I think that's a good thing. So of course it's going to be different. There's going to be more scrutiny on onboarding, more tests on your actually credit risk, more collateral required. That might hurt the initial liquidity a little bit, because if capital is harder to come by, then definitely the liquidity is a bit less. But at the end, this added security brings a lot more capital in. So I think that the net effect is definitely a very positive one, for the market as a whole. So I guess a bit same thing. It's nice to run things up, same as the beginning. Some short-term challenges potentially, but clearly a net positive on the longer term for the market as a whole.
So what I'm hearing here a little bit is that even if collateral requirements might be higher, because until now there were a lot of agreements going around with 0% collateral, open rate, whatnot. So now maybe let's say we do have it like 80, 100%, but since there's going to be more liquidity coming in because of this, there's going to be a net effect. Is that what we're...
Yeah, I believe so. And I think a client of ours at an event recently summed it up well in very simplistic terms. I think the liquidity that will be offered, with the self-exchange will be more grown up. This loosely but well said, I think, and it's well understood that it's more grown up, it's more selective, because it's, as what Kevin's pointed out, it's probably gone through the right pains in terms of getting to the point where it's going to stand up against it, other factors. Yeah.
So you do have one last question. I don't know, James, you had a comment or?
No, I was just going to say, I think risk is everything. I think you're going to go to dinner parties and people are going to be the sexiest person in the room if they're a risk manager rather than a trader these days, because I think they're going to hold the keys to the universe, both from LPs funding, trading opportunities, from traders managing books and strategies, from counterparties. Like, it's a thoroughbred, I think, thread of risk that will sit and reside within every part of digital assets, which is a good thing. I think we just need to carefully manage that so that it doesn't become like a bottleneck to opportunity. But I think that risk will be like the marquee kind of changing point that allows people to enter at real volume and scale, which increases the liquidity pool, which reverberates all those things. I think we're going to move. We have certainly seen the move away over the last 2 years when we were seeing prospects running $10 billion books on G sheets, trying to run their risk management and saying it doesn't really matter because markets go up and right. To now, like, their LPs funding them, asking them how the bloody hell do they manage their infrastructure and their books and their strategies that go with it. And we'd like you to meet our risk manager. Like, that sort of stuff wasn't happening, and wasn't certainly happening from 20 to 22. And now I think everybody's thinking that that's the next best thing for us to get some real breadth and liquidity and opportunity over the next 3 to 5 years.
By the way, that's exactly what happened in traditional finance after the financial crisis.
Yeah.
So if you're a risk manager in traditional finance, now's a good time to come into crypto.
I think it's this thing about risk or de-risking. The key thing is you see clearly what's playing out. It's the separation of responsibilities, right? It's an old age thing about how do you diversify, de-risk, because we talk about risk management so much. And I think we see much more not new models, but different variants in terms of how the digital asset space or the ecosystem, we're reorganizing ourselves, organizing deck chairs a little bit in terms of exchange, what is the main focus and purpose, the provision of liquidity alongside market makers OTC desks. But then the idea is about the matching of orders. But then you have specialists that deal with custody, with settlement, some others focusing very much on the KYC and AML section. So I guess the idea is to keep making sure that there's clarity in your business plans and have laser focus on what you're good at. And that brings up to Kevin's point at the start about longevity and sustainability of the strategy. Trying to be everything or, trying to have a whole house that has a big party house that does everything, cater to everything, the music, the catering, food, entertainment. It may work for some time, but you're going to blow out very quickly, I think. So, yeah.
Kevin, a final thought?
No, I didn't know James started in risk. I just discovered.
Love it.
But,
I want to be a risk officer.
I think actually I'm gonna wrap it up with this. I don't know how audience questions work. I don't know if we can. Oh, there you are, right here. Awesome. I did not see the screen. Okay, so quickly, when do we expect liquidity to come back to market? Are there any catalysts we need? Actually, my last question was around that, and we have interest rates pretty high right now, right? But let's say they start lowering also next year. We have a few catalysts next year coming up. How do you see this playing out?
What's the growth story in crypto? We don't have the next one yet. I mean, we had the DeFi summer that maybe drove the last one. I think people are looking for a reason to come back to crypto at the moment.
Yeah.
Yeah, there's some immediate Bitcoin halving type events that happen. There's some minting of new coins, that come from institutions or governments that, create stablecoin opportunities for people to be active and test their opportunity. And then I think the receding nature of these, whatever we are at now, 18,622 tokens that are out there, reducing down to a more rational set of tradable opportunities. I think that brings liquidity, into a more centralized opportunity so that they can be traded far more, vehemently.
I think the second question to some extent answers the first as well. I think that what we're seeing now with real world assets, it's kind of a bit of a rebranding of something that has been talked about since 2017, being STOs, tokenized securities, and so on and so forth. But I think that this is something that is really gaining momentum and interest, because at the end of the day, I believe that this is why blockchain technology makes sense. It allows you to represent value digitally, and crypto as a whole is kind of one first experiment. What first type of value that we're representing digitally, we see what that can do to liquidity and the ease of exchange. If you apply that to all other assets, I think that you get something extraordinarily interesting, and this is definitely gaining momentum currently. Of course, it takes time because there's a lot more regulation involved, which is a positive, so it takes longer. But I believe this is kind of the emergence of the next narrative that will bring liquidity back and bring a bit more activity to the market.
Yeah, I think banks are, the beginning when they dabble in crypto, I think would they use that as a way to say what is our minimum economic viable use case, right? To go fully into this area, because actually the big prize here is about tokenization, because of the question around tokenized assets here, and they needed the impetus, and we got evidence there coming out that the first dip into crypto trading itself, it can work, provided a couple of things happen around it as well. I've had to say this about regulation clarity, especially for our region in the next 12 months. It's actually going to help, I think, with the liquidity and ETFs. Boring as it sounds, but I think ETFs and the way that the market's reacting to crypto and ETFs and crypto, that will mean that I think it becomes a much more well understood and well governed instrument that play. So I don't know whether we're supposed to give an exact date and time about the question when liquidity is expected to come back. But I think we remain positive, I think, as a whole.
Hopefully within the next year, but I love this positive final thoughts. And with that, thank you everyone for coming here. Big round of applause to our speakers today.